We got the Fed coming out tomorrow. We got Bank of England, Bank of Japan this week. Microsoft, Meta, Amazon, Apple, tons, and jobs too. Kathryn Rooney Vera joins us, Chief Market Strategist at StoneX. Kathryn, great to have you here this morning.
Thanks, Oliver.
Super busy week. In that kind of list of items, what ranks top priority to you?
Oh, the Fed is top priority. The Fed trumps all things, even the election. So I think that's where the market is going to be mainly focused. Is the Fed dovish? Is it hawkish? Are we going to get that September cut? Or is it going to be pushed out down the line? That's really what everything is hinging on. And I would say that even this somewhat of a drop that we've seen from tech and this rotation outwards from tech and looking into small caps, I think is going to also take some wind in the sails or headwinds from Fed speak and the FOMC decision this week.
With Jackson Hole in August, what maneuverability does Jerome Powell have here? How much do you think he needs to start laying out the steps to the cut, or can he do that next month?
Yeah, I think he can do both. I think he can probably talk about it this week, set the stage, and take it month by month, which is what I think he's going to be saying. Data dependency is going to come back to the fore. Month to month is going to be the talk of the town, I think, both this week and at Jackson Hole. But they want to cut, so I suspect they will. Whether it's September or December, it doesn't matter to me as much as does the ultimate terminal rate, the long run rate. Where do we end? And I think that's going to be ultimately much, much higher, Oliver, than what both the Fed and even the markets are expecting.
When we look at the Fed next to Bank of England, next to Bank of Japan, you've kind of got the exception for the central bank regime with the Bank of Japan being somewhat hawkish. But what does all that mean for the dollar, Kathryn? Do you think there's any potential for the dollar to firm up? Or if we're heading to cuts, is this on a one-way train lower?
Yeah, I actually think that the dollar is going to be stronger in the near term now through the next 12 months. And I think that even the election outcome could invariably push the dollar to the upside. And I mean, not just tariffs, which I think are not just a Trump trade, but it's also an industrial policy trade. Industrial policy being, in my view, a euphemism for protectionism. Because let's face it, Donald Trump's tariffs were maintained and added to by the current administration. And industrial policy, i.e. protectionism, as I see it, is globally adopted at this point. So I think the risk of trade war is high. Under any scenario, obviously higher under a Trump scenario, but I do think that's dollar positive. And when you add to that, Oliver, the AI investment boom here in the United States and the influx and the overweighted positioning and ongoing interest in U.S. dollar denominated assets, that to me says dollar strength for the near term. Of course, when we're talking structurally, we have a dual deficit here in the U.S. We've got a massive fiscal deficit, big current account deficit. All of that, of course, is structurally weaker. But I do think that given the dollar strength, the dollar, the high yield, high carry nature of the dollar, and the fact that, as I alluded to earlier, Oliver, that the Fed is probably going to stay or move rates down, but not enormously lower. So I think that high carry, that massive differential with the euro and anyone else that we look at is going to keep dollar inflows coming and dollar strength as a result.
It sounds like you think maybe they could do like a one and done or a one and a pause, a couple and a pause. Is it wrong to generally price in a full cut cycle, which is historically the way it works? You move in pretty big swings when it comes to Fed rates.
Yes, normally it does, but I think my biggest concern with the Fed right now is that it loses credibility if it does, in fact, cut as soon as July or September, only to have to hike later in the year. So that's a real risk, or later next year. I'm not saying that's the base case scenario, but I do think that if we get a reacceleration in inflation, a reacceleration or overheating of the U.S. economy, imposition of tariffs and the like, I think there is a risk for reacceleration of inflation. So that's why I think the Fed maybe kicks it off in September. The market's giving them the opportunity to do so. Potentially does again in December. Maybe not. They're going to call it month by month. It's going to be very volatile, I think. And I think the Fed being the main driver of the markets, it's not inherently positive. It's not really where we should be. But my suspicion, Oliver, is that from now through the next 12 months, that's where we're going to stay. And the Fed's going to be the main discourse of every trading day for the foreseeable future. And we're all going to be kind of hanging on to every word of what Jay Powell says in every presser, every communique, every Fed speak, because it is going to be uneven. I don't think this is a big easing cycle. I don't think they drop rates 200 basis points. I think they probably, from beginning to end, could drop 100, 125 basis points, but that keeps the long run rate pretty darn high.
Kathryn, as we look at some of these shifts in policy, whether it's the Fed cutting, Bank of Japan firming, I know it's StoneX, you guys work a lot with clients on cross-asset stuff and kind of global themes. There's this idea that the Japanese carry trade might be like kind of fully unwinding. Some have pointed towards the yen as a source of volatility or kind of a gauge for volatility the last couple of weeks. I'm curious how much you guys are watching that, and if you think that does make a difference here at all.
Yeah, we've seen a big short squeeze. Look, I think that the yen could be a possible opportunity to go long. We've been liking short Swiss franc yen for some time, but we're not quite ready to jump in on that trade. I do think ultimately Japan is going to have to increase rates, but ultimately I'm still waiting and holding on that call. The safe haven status, I think, is there, but we're just not ready to jump in that yet.
Okay. So looking for then the dollar to kind of hold its own here, how much does that create an issue for stocks? Do you think U.S. equities are at risk of the central bank discussion, the dollar discussion, or is this, I mean, the last couple of weeks, it's really been a lot of tech stuff. Like if we get some amazing number out of any of the four big ones this week, does that have the potential to put a bid into beating down tech stuff?
Yes, I do think that we may be getting ahead of our skis with regard to this rotation that has taken tech stocks down. There's a lot of talk of antitrust possibilities coming in if we do get Trump 2.0. I prefer putting hedges on those tech positions, so buying put options on tech or on the AI trade. So I do think that there is a downside risk in the near term for stocks in general, and that's the technicals. But if we look at the fundamentals, when you look at the earnings report, we've seen about more than 40% of the companies that have reported this quarter not beating sales. You know, earnings are beating, but sales are not. So, and when you look at McDonald's, it also in the recent earnings report also disappointed. So I do think that there's some wins on the horizon, and we're seeing it now. I think the unemployment rate is one of those phenomenons that's probably going to move higher, affecting consumption and affecting the sales numbers. And that's what I'm generally focused on. So my message is protect your positions. I think there's opportunities in the markets to be defensive, and that's the purchase of utilities as a sector. I think utilities does well both under the second derivative idea of the AI trade. Let's say this continues to go full steam, then utilities probably catches a very nice bid, or utilities does well because, you know, we go into a recession or the Fed has to hike rates again. Any of these fat tail risks, I think that there are opportunities to position defensively, and you want to do that now. You want to do that when the market is very high and optimism is there.
To your point, positioning defensively, Kathryn, I'm going to pull up the SOM chart again, just taking it from your report, since you mentioned unemployment and the week culminates with jobs. It seems like this, I get your point when you talk about the rotation being a little bit premature, because like, isn't that supposed to happen once you're coming out of the recession? According to this, we are the closest we've been in really years.
Yeah, we are. And actually, you know, even Dr. Som herself has said, look, even if we trigger, it doesn't necessitate that we're in a recession at the moment. But when you look at history, this is an indicator that's been pretty accurate. So even when there have been false positives, you've seen recession occur 6 months later. So we shouldn't rest on our laurels here, you know, and say that recession is a phenomenon of the past or that it's never going to happen again, or it's certainly this time is finally different. I do think you have to be careful, and I think gold makes sense, steepeners make sense across asset class, because you referred to that, makes sense to protect against these fat tail risks, which means that maybe it's not the perfect landing scenario. The fat tail risks are bipolar in nature, and that means either a renewed reacceleration in economic activity with which comes inflationary pressures again, or we get this recessionary phenomenon where we get corporations that finally are facing those margin pressures, have to cut costs, and the easiest and quickest way to cut costs is by cutting the fat in the labor market. You know, we have this job hoarding over COVID, where corporations found it so hard to hire, so they're just keeping, you know? So I think that that's probably the main risk from my perspective with the economic cycle, that we could see a jump in the unemployment rate and a shedding of labor to shore up the bottom line for these companies.
You know, it's a good point. I do wonder maybe in our list of things, maybe it's just employment that's number one at the end of the day, at the end of the week, right? Because if we start triggering more recessionary indicators, that's never good. We're already uninverting the curve. That's in the same kind of realm. Kathryn, great stuff, great analysis. So utilities is the derivative AI play, and defensive gold works in the steepeners. Appreciate your analysis. Thanks for being here, Kathryn.
Thank you. My pleasure.
Absolutely. Kathryn Rooney Vera, Chief Market Strategist at StoneX. All right, some good thoughts there, and a reminder here that there's a lot at stake in the employment report going forward when we are that close to triggering recessionary indicators.